Hi, John Wilkinson and History Made Easier. I'm going to look at the collapse of the American economy at the end of the 1920s. A collapse that was sparked by the Wall Street crash in 1929, but wasn't entirely caused by that crash. There were fundamental flaws in the American economy. I've already talked in another video about the fact that the consumer boom that America enjoyed in the 1920s was always going to come to an end, and an end sooner than it need have done, simply because not enough Americans were earning the kind of money that would allow them to take part in that boom. And so the market was going to be saturated. Remember, 60% of Americans were living on or below the poverty line. American farmers had enjoyed a boom too. This had been driven by World War I and Europe's need for food. And in the after years in Europe, whilst Europe was still struggling to get back on its feet, that demand for American wheat still continued. And this encouraged American farmers to expand their farms and to invest in expensive machinery. But as Europe recovered, that market too was saturated. And so American manufacturers and American farmers were finding themselves in trouble. The American economy wasn't all a success story in the 20s either. The older industries that were being replaced by new technology were struggling. The coal industry, for example, oil becoming much more important in America. The cotton industry being replaced by the new rayon fabric. These were also signs that not everything was great in the American economy, even in the boom years. 500 banks went bankrupted during those boom years. Yes, they were mostly local banks, but still it was a warning sign that not everything was great. And by 1926 there was a big warning sign, because the construction industry in America was slowing down. Now, two things about the construction industry. One, they employ a lot of people because it's labor intensive. And secondly, they are a signifier that an economy is healthy or not. Because if you're building for the future, you're investing in the future. And when that begins to slow down, it's an indicator that there isn't the confidence around that there once was. Factories are not being built or extended. Major projects are not being undertaken because money is getting tighter. So there were warning signs there. But if we take ourselves into Wall Street, we see a world going on that really is not in touch with the reality of the American economy. Because what was happening in Wall Street was that share prices were going up and up and up and up, no matter what was going on in the American economy. And there are two, I think, key factors here. One, more people were coming into the business of buying shares. At the beginning of the 1920s, there was something like 4 million shareholders in America. By the end of the 1920s, that was up to 20 million shareholders. Now, there are 3 real golden rules in buying shares, in playing the stock market. The first, and probably the most important, is you've got to know what you're doing. The second, and it's pretty important, you've got to be able to afford it. You've got to be able to afford to play the game. And the third thing is that really you've got to be in it for the long haul. You've got to be able to hold on to those shares for a good period of time in order to let the rise and falls play out, and the underlying trend will usually lead to an increase in prices. But you've got to be able to hold on to those shares for many years. But what was happening in America was that people with a bit of spare cash were seeing the profits that were being made in those boom years, and they wanted a bit of the action. But they didn't really know what they were doing. Not only that, the way in which many people were buying shares was to borrow money to buy the shares. It'll be all right. I'll buy $100 worth of shares, keep them for a few months, sell them for $125. I've made $25 for doing nothing. Can't go wrong. Oh, but you can go wrong, because the presumption was that share prices always go up. But what was happening in the real American economy was bound to be reflected sooner or later in the stock market, because the prices that people were buying their shares did not reflect the value of the companies that they were buying shares in. People were buying in ignorance. People were buying for short term. We talk about investors and we talk about speculators. Investors play for the long game. They will hold on to their shares for many, many years. Speculators want that quick profit. The other factor in this, I mentioned 2 factors at the beginning of this part of the video. The other factor was that banks were facilitating this. Banks were allowing people to borrow money to invest in the stock market when they did not know what they were doing. And so banks had a responsibility here. The whole thing was unregulated. The stock market itself was unregulated. The business of lending money was unregulated. It was left to go totally out of control. And so when seasoned investors began to get really anxious about this upward spiral that bore no relation to the real value of these companies, when they began to get anxious and started selling their shares, the market panicked, and the rush to sell shares developed into a stampede. Now, I talked in an earlier video about how little I know about economics, and honestly, I know very little. But another basic thing I know about economics is that somebody is when you have a lot of people who want to buy a few things, the price will go up and up and up. And that is what was happening in the stock market too. You had all these millions of new buyers coming in, pushing the price of shares up. But when you have millions of people wanting to sell those shares, the prices will come crashing down. And that's what happened. And almost everybody was burnt by this. The experienced investors, because the whole game had been taken out of their control by all these new buyers and the unregulated markets getting their loans, buying on the margin, as it was called, in order to make a quick buck. That took the control away from the seasoned, experienced guys who did know what they were doing. So they got burnt in the crash. And the speculators, of course, got burnt because many gone into debt. They had at least used their savings and they'd gone wiped out. But so did the banks get burnt because they had been foolishly, and they should have known better, but they had been foolishly loaning money to the speculators, everybody thinking that they're going to make quick profits. And it's that sparked the crash. The economy, already saturated, couldn't help in a recovery. Unemployment that was already growing shot up as companies were forced to close down, at least temporarily, maybe close down permanently, and we have a ripple that becomes almost a tsunami that spreads out from America, and we have a major world recession, the Great Depression. So I hope that ties the economy to the events in Wall Street together for you, and shows how these two things are interlinked, and we can't really explain the Wall Street crash without looking at the state of the American economy. As always, I thank you for listening, and as always, I encourage you to check out my History Made Easier website. But cheers for now. Cheers.